Welcome to the IA Investment Management Macroeconomic and Market Update. Today, I'm discussing with Jean-René Adam about our outlook for the equity markets. Jean-René is the head of public equity at IAIM. My name is Rose Marcello, and I'm Director, Client Portfolio Manager. Jean-René, thank you for being here today.
Happy to be here.
Well, let's discuss market. Things are not looking good. So equity markets have been falling sharply since the beginning of the year. Do you think that current valuation supports stocks at this level?
This is a very good question, in fact, and despite the important correction that we've experienced so far in 2022, I don't think we can say that the market is cheap currently. I'll give you an example. If you look at the S&P 500, it is now trading at around 16 times forward earnings. So this is way better than the 23 times we had at the beginning of the year, but it's only back to its long-term historical average. So we have to be careful not to anchor our view on the stock valuation that we had during the pandemic period in 2020 and 2021. So remember that during this period, the market was flooded with trillions of dollars from central banks and government. This was not a normal environment, obviously, and it led to excesses in valuation that we are currently getting rid of. Another way to look at equity valuation is to analyze the equity risk premium. So this measure gives you a very good indication of the excess return you'll earn by taking more risk and investing in the stock market instead of buying a risk-free investment. So the way it is calculated is the reverse of a price earning multiple, which is called earnings yield, so E on P. And then you subtract a risk-free investment, which is a 10-year government bond yield. And as you can see on the chart here, the higher, the better. Intuitively, you would think that with the market correction that has brought a lower PE, the equity risk premium would have increased, but it didn't, because during the same period, the risk-free investment improved as well with the massive increase that we've noticed in government bond yield. So all that to say that we cannot say that the equity valuation is cheap enough to support the market. What we can say, though, is that it's back to a more normal level.
Okay, I understand. So just to clarify, when you mentioned the higher the better, you mean the higher the yield is, it's the cheaper stocks are.
Exactly, yeah, compared to the bonds.
Yes, great to know. So you just mentioned the US market is trading back to its historical average in terms of valuation. But are there some segments of the S&P 500 that are actually attractively valued right now?
Yes, there are some segments, but you really need to look under the hood to find opportunities. So something that has struck me lately is that while it's true, I just alluded to the fact that S&P 500 is trading in line with its history. When you decompose the index, you realize that the distribution of valuation is far from being normal. So the largest stocks are way more expensive than the smallest ones. And because of their weight, they are tilting the valuation of the S&P 500 higher. So for example, the top 10 largest stocks in the S&P 500, they represent almost 30% of the index, and they trade at close to 24 times forward earnings, while the remaining 490 stocks trade at a little less than 14 times. And what's even more interesting is that larger cap names are also more negatively impacted by the strong US dollar, given the fact that they export more than smaller cap names. So that's another reason to favor small cap right now. I can illustrate that with another example. So when you compare the valuation of the S&P 600, which is a small cap index, to the S&P 500, you can see the chart on the screen here. You can see that historically the S&P 600 usually trades at a premium of around 2-time multiple versus the S&P 500. But now it's completely the opposite. And they trade at a 5-time multiple discount at only 11-time earnings, which is the lowest valuation we've seen over the last 20 years. It's even lower than what we experienced during the 2008 financial crisis. So we feel that there are plenty of opportunities in smaller cap names, and this is really where we are currently focusing our energy. And by the way, the situation in Canada is very similar.
Okay, so I know that Canada doesn't have like the large cap traders like they do in the US. But speaking of Canada, anything else that stands out in this market?
Yeah, so as you know, we've been very bullish on oil and energy stock. And, despite the correction of the last few months, we still believe that this is a great investment opportunity. And so, in fact, when you look at the current situation, The oil market is even tighter than it was when oil price was at $120. Global inventories have continued to trend lower to really one of its lowest level in history. So the question that you would probably ask me is why has it corrected? And the reason is the same then, why the market has corrected. Central banks being so hawkish, increasing interest rates so rapidly, investors are expecting a global recession, and oil demand is cyclical. So people are thinking that, rightly so, I think that oil demand growth can reverse in the coming months. And we agree with this risk, but we still feel that supply and demand is so tight that even under that scenario, inventories wouldn't increase materially. And on top of it, you have the OPEC that have been pretty aggressive lately. So we think that they would certainly act and cut production if that scenario materialize. Other bullish factors that we're seeing, political risk, we think is as high as it was earlier this year, with the war between Russia and Ukraine that, doesn't seem to be ending at all. You have also the US that they need to rebuild their strategic petroleum reserve, another bullish argument. More and more people are going back to the office, so they're going to use more gasoline. And another positive would be, we've noticed demand destruction in spring and summer when oil price was way higher, 35% higher than it is right now. And that demand destruction might come back as well. And the final argument I would say is when you look at how cheap the stocks are. So you can see the table on the screen here, the free cash flow yield in Canada is between 18 and 26%. And even if you look in 2000 and next year, 2023, let's say that oil price is at $75, it's still 15% free cash flow yield. So very, very interesting. Medium to long term view also, if we stretch our neck, over and above the probable recession we're going to get, there's still a lack of new supply, lack of new production coming in. So we think that the market will be still very tight for years to come. So this is really what we consider the best opportunities in Canada on top of small cap.
Great to know. And so all in all, quite a bullish view of Canada in the medium to long term.
Exactly.
Well, thank you so much, JR, for taking the time today.
Thank you very much, Rose.